Derivatives. You know, the word itself can sound pretty complicated, right? But what if I told you that pricing them is actually way more straightforward than you think? In this explainer, we're going to pull back the curtain on how these powerful financial tools get their value, from futures to options and all the way to swaps. Let's dive in.
So here's our game plan. We'll kick things off with the basics. What even is a derivative? Then we'll walk through the big three: futures, options, and swaps, and see how each one gets its price tag. And to wrap it all up, we'll talk about why any of this actually matters in the real world. Simple as that.
All right, before we jump into any fancy models or formulas, we have to start at square one. We got to get a handle on the core concept. What in the world is a financial derivative? Let's break it down. And there it is. At its heart, a derivative is just a contract. But here's the key. Its value isn't based on what it is, it's derived from something else. You know, kind of like how a ticket to a concert isn't valuable because of the paper it's printed on, its value is derived from the band that's playing. In finance, that something else is called the underlying asset, and it could be anything: a share of stock, a government bond, or even a barrel of oil.
Okay, let's tackle our first type, futures contracts. The absolute easiest way to think about a future is to imagine you're pre-ordering the hot new smartphone. You agree on a price right now, today, to get that phone when it's released in a few months. You're literally locking in a future price right now.
Now, you might have also heard about something called forwards, which sound pretty much the same, and they are, but with one huge difference: standardization. Futures are like stocks. They're standardized and traded on public exchanges, so they're super easy to get in and out of. Forwards, on the other hand, are totally custom, private deals made directly between two parties. So how do they come up with that price you're locking in? Well, it's not just a random guess. It all starts with the asset's price in the market right now. That's called the spot price. Then, you add or subtract this little thing called the basis. The basis is just a way to account for stuff like storage costs or interest you could have earned, basically the cost of holding on to that asset until the future date. And this really shows you the scale we're talking about. A single futures contract for corn actually represents 5,000 bushels. So if corn is trading at $5 a bushel, that one contract controls $25,000 worth of corn. It's amazing, really. It lets farmers and traders manage massive quantities of a commodity with just one transaction. All right, next up, let's talk about our second derivative, options. Now, if a future is like pre-ordering a phone, an option is more like putting a small, non-refundable deposit on a house. You've locked in the right to buy that house at an agreed-upon price. But, and this is key, you don't have to. The magic word here is choice. So how much is that choice worth? Well, its value is often calculated using the famous Black-Scholes model. It looks super intimidating, I know, but it really just boils down to 5 key ingredients: the asset's current price, the price you agreed on, the strike price, how much time is left, interest rates, and, this one's a biggie, volatility. The more an asset's price jumps around, and the more time you have, the more chances your option has to make you money. That makes it more valuable.
And this quote right here, this is the heart and soul of an option. It is the single most important thing to remember. With a futures contract, you are obligated to follow through. With an option, you have the right, but not the obligation. If the deal goes south, you can just walk away. All you lose is the small fee you paid for that right. That flexibility, that's what you're paying for. And that brings us to our final stop, swaps. You know, the name pretty much says it all. This is all about an exchange. Just imagine two companies. Company A has a loan with a fixed interest rate, and Company B has one with a floating rate that changes. A swap is just a private deal where they agree to trade or swap those interest payments with each other because it benefits them both. Now, the secret to pricing a swap is actually this really simple idea: fairness. When the deal is made, the total value of all the fixed rate payments has to be exactly equal to the total expected value of all the floating rate payments. The swap has to start with a net value of 0. Why? Because if it didn't, one side would be getting a free lunch, a risk-free profit, and that just doesn't happen. So the most common version is what they call a plain vanilla swap. It's super simple. Party A pays a fixed rate to Party B. In return, Party B pays a floating rate to Party A. And notice that little note at the bottom, it's super important. The actual loan amounts, the notional principals, they're not exchanged. They're only swapping the interest payments that are based on that amount.
Okay, so we've talked about the how of pricing futures, options, and swaps. But let's be honest, why does anyone go through all this trouble?
Let's zoom out a bit and see what purpose these things actually serve in the big picture. It really all boils down to these three things. A farmer can use a futures contract to lock in a price for their crop, which is called hedging. It protects them if prices fall. A trader might use derivatives to take advantage of tiny price differences between markets. That's arbitrage. But most broadly, these tools are all about risk management. They let a company pass off a risk they don't want, like changing interest rates, to someone else who's willing to take it on.
Which brings us to our final question. After all of this, what's the real story here? Are derivatives these essential, complex tools that help businesses manage risk and keep the economy stable? Or are they just a fancy, high-stakes form of betting? The truth is, they're kind of both. And understanding how they're priced, well, that's the first step to being able to tell the difference.